Hello, everyone. Thank you for joining today's call. We put this together yesterday, so glad we see so many of you joining us. I'm going to put up a presentation and have some talking points just as way of introduction, just in case people haven't, I haven't had the privilege to speak or meet any of you. I'm Joe Halpern. I'm the Chief Investment Officer of Fountainhead. And what we're going to do here today is I'm going to make a brief presentation. With the invite, we had asked if anybody had some questions, and we got a number of questions. So thank you for those who sent it ahead of time. And for any of you who have not sent questions, do not be concerned. You can add, I think there's a Q&A button near the bottom. And so you could add questions on the bottom, and we will try to get to them all after the prepared remarks. So let me share my screen. Okay. So I believe I'm sharing. I'm going to ask someone from the team just to Teams me or text me to make sure you see it. It says potential effect of the tariffs. Yes. Okay. Excellent. Thank you. So today we're talking about potential effects of the tariff announcements on the economy and markets. And number one is what exactly happened. Let's touch a little bit on the history here. Liberation Day, April 2nd. I guess it's a brand new day. And ultimately, we had a bit of a crash. The graphic on the left is AI created. We'll talk a touch about innovation towards the end. But there's lots of copyright law around, and nowadays we can just go into AI and say, give it a couple prompts and it makes that beautiful picture, as opposed to going and having to make people make pictures. So anyway, going back to Liberation Day. On that day, President Trump, post trading day, so roughly 4 to 5 p.m., announced baseline tariffs of 10% globally. And the market actually, I think, was expecting a little bit more than that, actually, but then he announced reciprocal tariffs. And those reciprocal tariffs were much higher than the markets expected. And it also confused the market. And we'll talk about that because that really plays into uncertainty. It confused the market because it was presented as reciprocal to tariffs that other countries were charging America. But in fact, it just was it was inaccurate. And what we now know from a lot of very quick sleuthing and a lot of very quick basic math is that the numbers presented were not tariffs. It was really the trade imbalance between us and the country in question. So as an example, South Korea was presented as having a 50% tariff, and therefore we were going to place a 25% reciprocal tariff on South Korea on top of the 10% baseline tariff. But in reality, the US and South Korea has had a trade agreement. They're an ally of ours. And we have had a trade agreement in place since 2012, where the average tariff is roughly 0.75%, so less than 1%. And so where did that number come from? Where did the 50% come from? It really is a representation of our imbalance with South Korea. If South Korea exports to us, or we import from South Korea $1.5 million worth of goods, and we export to South Korea 1 million, that's a number that's 50% higher, and hence the 50% tariff. So we'll get a little bit into that. But ultimately, if you look at this, sorry, I didn't mean to do that. If you look at this US weighted average tariff rate, the graphic on the right, Smoot-Hawley was an act that economists and historians point to a lot as something that really made the Great Depression much worse. That was an increase of about 7%. The estimate, it's based on the announcement on April 2nd, are closer to 30%. And that is, simply stated, just going to be a negative drag on the economy. So what are the issues? Issues number one, and this is straight math, everything will cost more. It's inflationary. If you go and you put a 35, right, the 10% baseline, 25 reciprocal on anything that comes in from South Korea, everybody who's importing it has to make some level of decision of how to pass it on. And so everything will cost more. And when everything costs more, you have your classic kind of going back to economy 101. We have a supply demand chart. And if the costs increase, consumption tends to decrease. You just buy less of it. And when consumption decreases, it's recessionary. It's actually deflationary, but here you have inflationary because prices are going up and consumption's going down, and the prices are not going to follow it down because of the impediment, because of this just extra tax. And it really is a tax on everything. I want to step back for a minute. Why did the Trump administration do this? Just really high level. They stated it's protectionist. This is a protectionist administration. They're really worried about or I shouldn't say worried about, but they don't like the trade imbalance. They want to get rid of the trade imbalance. They want to bring manufacturing back to America. And tariffs are kind of one of those items that the executive branch has maybe a bit more control of, we'll discuss it, but a little bit more control of as opposed to some other mechanisms that maybe they could have used. So just stating back for a second, that's maybe why they went and started this tariff war. The more esoteric and probably the more, I don't want to say meaningful because inflation is meaningful and consumption declines are meaningful, but a really material portion of why the market moved down is uncertainty. And uncertainty exacerbates recessions because ultimately it dramatically increases business planning, and that leads to paralysis. It also, by the way, it increases the risks for just consumer planning. You know, what do we do? Do we go and change our living room and get new furniture? Who knows how much it'll cost if we have to buy it in 2 months? So maybe we don't do that. And so uncertainty was already very high. And we've been using this in our market commentaries and in our talking points over the last 2 months. We actually highlighted it 2 months ago, and we highlighted it in the market commentary that just came out this Friday. This measures US economic policy uncertainty. And we circled 2 areas of the graph. The first one is actually in July 2020. So March 2020 is kind of the little spike right before the one we circled. And then, March 20, and then I think it's August or September, a little later in the summer is that other spike. And that was a very uncertain time due to COVID. We weren't exactly sure how long we'd have to stay at home. Unfortunately, it was way longer than any of us thought. And by the way, we came out well from COVID, but at those early days were scary. Here you can see, and by the way, this is a measurement from the last day of March, so it does not capture April 2nd. There was a lot of uncertainty already due to the tariffs being put in place and taken off and put on place again with Mexico and Canada. And the way this is measured is news articles referencing uncertainty, dispersion of economic forecasts, and then changes in policy. And so I imagine this is going to spike even further next month, and we will share it. It's a permanent feature within our market commentary going forward. If you scroll down past the first part, we have a second part which kind of speaks about market actions, and we'll have it right on the top for anybody who wants to follow it. And on the market commentary, there's also a footnote which tells you how to find it. So if you don't want to read the commentary, but you just want to see it, you can find the footnote, find the link, and save it. So business uncertainty. This is a little bit of a busy mass graph on the left. What this measures is 2 items. The PMI is just a very popular measure that Wall Street follows. And this one in particular is around future output expectations. So it's basically asking managers what their expectations are for future production and future output. And you can see in this graph again, this is March 2025. So not post April 2nd, not enough measurements have come out yet for that, but we are already going this direction where the lower you go on this graph, the worse it is. and it's going down. My expectation is that's going to go into the 50s. And that's a bad measurement. And that means that businesses think that they are going to lower production and lower output going forward. So again, that's recessionary. And then finally, consumers. Here again, this is going through the end of March, and it's asking consumers about their future expectations, what they expect for their own financial situation, what they believe the economy will do in the short and long term. And again, you could see that it's going down, and it's going to go down again some more. And all this is sentiment. So, excuse me. And sentiment's important because it's basically how do people feel, and based on how they feel, that's what they're doing. And when it comes to businesses and consumers, it's not only how they feel, but it's just how they could project going forward. So if you're a business and you have to work on a project and you don't know what the cost inputs are, or the cost inputs became much more volatile or much more uncertain, you may decide not to do that project because there's too much risk. Or you may decide the only way I'm going to do that project is if I could charge a lot more, which means that the pricing is inelastic, because if you charge a lot more, it may not be consumed. So it really creates these hard decisions. And just really quick, just to kind of do a case study here, if you go back again to our market commentary, we did a case study just on softwood lumber, just to give an example. This was pre-April 2nd, but there were already being tariffs enacted. And this was a tariff enacted on softwood lumber of roughly 25%. And softwood lumber is used for house framing. So if you're going to go build a house, about 15 to 20% of the cost of that house is the framing. You typically use softwood lumber. 30% of the softwood lumber comes from Canada. If you put a tariff on Canada, those prices go up. You have to make purchase decisions. Do you now try to buy it from the US? Well, then you go back to supply demand. Where will the price of lumber go? Kind of the graph on the left going forward. How do you make decisions as a business leader or a business owner in terms of where am I going to purchase it? Does it make sense to substitute or figure out a substitute? One of the big problems with what's been going on is the uncertainty around the administration. It hasn't been really sharp communication. You can see that with Canada and Mexico, where we were on again, off again, on again, off again. And we expect the same with the tariff wars that were just enacted as of April 2nd. So that's an example of how uncertainty plays out, how sentiment plays out. I'm going to give some concluding thoughts here, and in about a minute, we'll turn it over to questions. So first, and this is pretty direct, tariffs are negative for the economy. There's no way around it. Even if there's some level of justification for tariffs, meaning you as an individual think these tariffs are great. That's fine for you thinking that these tariffs are great. They are negative for the economy. It's an additional tax. So again, that's a really separate and distinct statement from this is a bad policy or a good policy. This is what's going to happen. It's going to increase the costs of products that come into this country. That may lead to inflation because products will simply be more expensive. And it may lead to recession because people will consume less. Uncertainty further reduces that productivity output. Now, systems, checks, and balances. This was an executive branch decision, and the executive branch, basically the Trump administration, did this as an emergency declaration. That was the only way. Typically, tariffs are something that's worked out between the executive and the legislative branch, Congress. And it takes a long time, and they spend a lot of time just doing a lot of studies. We use an example in our softwood lumber example because there actually are tariffs on Canada, and there's been tariffs for the last 30, 40 years on Canada around softwood lumber. And currently those tariffs are 14%. So the 25% is going on top of the 14%. And already there's a semi-annual, so every 6 months, there is a report brought to a congressional committee around potential subsidies that Canada may be using for softwood lumber. And there's an argument between Canada and America in the WTO and the World Trade Organization. So there's already a lot going on behind the scenes in terms of general global trade. As an example, this policy that was enacted on April 2nd was executive and it was emergency decisions. Therefore, the judicial could get involved. A judge could strike it down and say, listen, it's not really an emergency. This is just a philosophical view of this administration. These trade imbalances have been going on since the 1970s. So how do you all of a sudden call it an emergency? The legislation could get involved. We have these amazing checks and balances in America where we have these three different groups that kind of fight for power. It's really beneficial for us, for the American people. I think it's one of the best systems out there. There's a whole bunch of elected officials who are going to be up for re-election in 2 years. We're already seeing some effects on the legislative side. As an example, there were 2 elections in Florida where people just squeezed by. It was replacements for people who joined the Trump administration. And it was one seat. It was actually someone who was going to join and then didn't join. And in both those elections in Florida, which were deep, deep, deep red districts, these Republicans won. They were supposed to be really safe spots, but they lost about 20% of the vote that went to President Trump. Wisconsin, the Republicans lost a state Senate seat. It was a really important state Senate seat. And then a rep from, I'm a New Yorker, a rep from upstate New York, Representative Stefanik, was supposed to be the UN representative for America. They just pulled her nomination. She would have flown through. She would have had no problem with, getting through and getting nominated by the Senate, but they pulled it because they were really concerned that that seat would flip to the Democrats. So there's already pressure there. There's going to be pressures on the legislative body to essentially go out there and potentially check the powers of the executive. Transactional, the Trump administration is very transactional. So it leads to uncertainty, but oh wow, lights out. But it can also lead to an adjustment down and have some benefits from a tariff standpoint. And then finally, error, which kind of leads to transactional, meaning that kind of that alluded to South Korea is really at 0.75%. There's a lot of negotiations going back to transactional. South Korea comes and says, listen, our tariffs really aren't there. We know this is trade imbalance, but how can we work through it? And then finally, history. I'll say one comment just about where financial markets went. As of yesterday in the morning, so kind of the low point, it dropped 15% from the point when, generally speaking, so S&P 500, NASDAQ, dropped about 15% to the bottom of yesterday. So earlier in the day before it rallied a bit from the point of the Trump administration announcing these tariffs. And before that, the market was weak. It was down 7 or 8%. So you really have a drop of 20, 25% from the top. And that's the market digesting it. So when you think about uncertainty or you think about sentiment about recession, these are things that are actually priced into the market already. So if you think, oh, wow, well, now there's definitely going to be a 40 to 50% chance of recession or 60% chance of recession, that's already priced into the market. By selling it now, you're not capturing that. You've missed it. But going back here, history shows we get it right eventually. Innovation will continue. Business will continue. They'll figure it out. Hopefully and traditionally and typically, uncertainty declines. We start getting answers. People figure it out. I think it'll be a combination of pressure on the Trump administration and maybe hopefully some early wins. And bad policy is eventually mitigated. So last page, and then I'm going to turn it over to, to get some questions here. What do we do? What's the fountainhead approach? One, diversification. This is something proactive. We diversify all of our portfolios. We do that through, as an example, international equity. We have exposure there, where at the beginning of the year, Europe did very strong in the back of Germany, kind of increasing budgets, which, by the way, you could potentially give as a win for the Trump administration, pushing Germany to do that. Fixed income, we've purposely leaned into ballast. Ballast, I'll say, is protection on the downside versus going into more risky assets that maybe generate larger income or larger yields. Non-liquid alternatives are another area where we look for further diversification and opportunity. Where appropriate, we'll tax harvest. That means taking a loss, but moving into an equivalent exposure in the market on your behalf, which helps at the end of the year and helps in further rebalancing. And then finally, we're constantly monitoring the market, constantly looking for opportunities out there, and constantly looking at what is the best to do on your behalf. So at this point, I'm going to flip it back. I think, Mark, you were having technical difficulties. I think you're good now. I'm going to turn back on the lights that automatically went off and pop right back. Okay. Mark, are we getting questions from the group?
Yeah, can you hear me now,
I can.
Joe?
I can hear you. Can you hear me?
Okay, we're having some technical issues, so if I any questions, we did have a lot of questions, which I appreciate from our clients. Hopefully, you guys can hear me. So one of the things we're going to do here is I'm going to try and these questions. Some of
You've got on mute.
them.
Say it one
Sorry,
more time.
if the questions, if I end up getting repetitive, sorry about that. And if your questions aren't followed up with specifically, we do have the questions here. We'll make sure that your advisors know that you've asked certain specific questions. That being said, sorting through a lot of these questions, Joe, a lot of it is fear-based, okay? Some of the questions we're getting today, like, hey, what do I do with the markets where they are right now? I know you kind of touched upon it a little bit. Some of the questions here were, potentially taking sales now, which would, lead to losses. That's on tax harvesting. You can expand upon that a little bit. And then as you kind of blend it in a little bit with what sectors are getting hit the hardest and maybe talk about why, and then also how the fixed income has held up. And that's kind of like a lot of questions there, but I'll kind of help steer you through it. But that's a collection of probably 10 or 12 questions narrowed into a summary.
Okay. Yeah. So you gave me four of them. I want to make sure I got them all right. So the first one was just like, do I exit now and go into gold? Was that basically the first one? Or safe haven? I believe that was the first one. So the market has already digested. It doesn't mean that the market's not going to go down more, but the market, as kind of commented, is already factoring in a recession. The market is a leading indicator, not a lagging indicator. And what that means is it really picks up on the sentiment, and that's why we went through this economic uncertainty, business uncertainty, and consumer uncertainty, because the market's digesting it. It's pricing forward for a bad case scenario. And my belief is that the market's pricing in a lot of it. Is it done? No. And we also don't have a crystal ball, so I can't tell you where a bottom is. But for someone who's a long-term investor, I believe it would be a mistake to exit your portfolio and go into a safe haven because you simply won't know when to go back into the market. And because the market's a leading indicator, it's not that everything will get rosy. And then all of a sudden, now that everything is rosy, the market's going to say, walk right in. Why don't you invest right now? It just doesn't work that way. So it would be a mistake to exit exposure at this point, unless, of course, you think the world's going to end. And that's a personal opinion that I don't share and we don't share here. So I would remain in markets and stay diversified with it. And you could speak to your advisor if it's something that's keeping you up at night. Perhaps you could lower your exposure a little to more risky assets. So that's it. In terms of question number two, and I might be doing these out of order. So Mark, you'll have to keep me in check. But the selling a product, when I talk about tax harvesting, so we're selling some securities now for some clients where we're selling one thing and buying something else that looks very, very similar. And that's simply to take losses. Everyone's allowed to take a $3,000 loss, which is an offset on your tax filing. So that just simply saves you taxes. And then it allows for diversification and other areas where we could save on behalf of the clients. So that's tax harvesting, and that's where you might see selling and buying. Number three, what are some of the hardest hit areas of the market? So interestingly, the hardest hit has been tech, and that's a function of technology simply and that's just been this year generally. And technology has a higher beta. They have a higher sensitivity to markets moving up and down. And some people might have thought maybe they got a little bit ahead of themselves. So that got hit early, and there might be an argument to say with the tariff wars, maybe they're a little less affected than some other industries. So that's what's gotten hit. What makes it so hard to decide in terms of a safe haven industry is that markets are correlated, meaning they move kind of similar. And if you think about a business that's American and has everything in America and isn't fully affected by tariffs, well, you still have to deal with recessionary concerns. You still have to worry about like just inflationary concerns and others. So it's going to hit kind of everybody, not uniformly. Obviously, there's worse places and better places. But then the flip is, and this goes into the decision making, excuse me, of like, well, what if tariffs are upended? What if instead of them being so broad-based, we start getting into narrow tariffs and we say, you know what, we're just going to focus on China and these three industries for these strategic reasons. And then all of a sudden, something that was really pushed down dramatically will pop up dramatically in the same breath. So again, we really believe in diversification. We do look for opportunity. Tech may be one of those opportunities in terms of where to move to, but we also try to be really conservative on behalf of our constituents. Mark, I missed one. I hit an exit, I hit tax heart, which is loss, and I hit
Did
kind
you talk
of
about
like
fixed income, the bond market
fixing.
in general? Just talk about
Yes.
that briefly.
So what was the question specifically on
Question
fixed
was
income?
just how is fixed income holding up in this and why?
Yeah, so fixed income was holding up until about yesterday, and then it started increasing a bit. Fixed income is generally a snap safe haven where if people do want to get out of exposures, equity exposures, they go to Treasury. Treasury is U.S. government bonds because that's uh, deemed to be the least risky of the products out there. That might have changed a little bit as people start worrying a little bit more about inflation. They may actually worry a little bit about budgets and the large deficit in some other areas. It's generally held up pretty well. It's worth noting, I think historically fixed income was more specifically kind of defined around Treasury and investment grade. Now it's much broader. There's a lot of riskier products incorporated within fixed income. One is high yield, which used to be called junk. And high yield, if as things remain volatile, those spreads will really increase a lot. We have very little exposure to those sort of products at the moment. But those products could continue to kind of spread out, which means that the pricing will go a little bit against you.
So talk about like real quick, Joe. So yesterday we saw this fake news for a blip where we had a 90-day, essentially 90-day ceasefire, we'll call it for lack of better terminology. What would you see? You talked about potential short-term wins. What could some of those short-term wins be? And how do those also, because there's so much uncertainty, affect how we're looking at some things?
Yeah, and I wonder, right? It's fake news. I think there's been a bunch of folks from the administration saying different things. And so who knows what that is, but I do think there'll be wins, kind of like what we saw in the first few months of this year with Canada and Mexico, where at first it seemed like a really worst case scenario. Then items were delayed, then certain items were carved out. And I fully expect that to continue to, I think we'll get some wins, to be honest. It doesn't mean that we're out of this and everything's great. But I do think that the Trump administration will digest a bit more of the reaction. And as they speak to counterparts that are allies, they're going to have to communicate what they want. And there's just a reality that the trade imbalances cannot be fixed in a day. They may, by the way, there's some trade imbalances that maybe can never be fixed, by the way, and that's not necessarily bad for America. So I'm hoping that there's really constructive conversations with different, like Vietnam's an example, India's an example, South Korea is an example. All these places are places that have kind of over the last 8 years as both the Trump administration and the Biden administration has hit into China, a lot of manufacturing has moved to those areas, and now they got hit by rather broad tariffs. And the question is, does America have the capability and an interest in manufacturing some of the stuff that we import from those countries? And the answer may end up being no. So I'm hoping that they narrow the effects of the tariffs and they could start communicating that. But I totally expect there to be some wins over the next couple months.
Okay. In general, I think that we I kind of consolidated a lot of questions. Some questions are a little bit too specific and or political to kind of discuss here, but you can discuss with your advisor. And then I think one of the things that I would say is a takeaway to really talk with your advisors is the tax harvesting, is the potential tax benefit, because that is one of the places where, we can, as a firm, use volatility. And there's a lot of volatility right now, but to our advantage, where we can hopefully gather some losses while some of this volatility is going on, and then hopefully we find some stability. So I don't know if there's anything else you want to say, Joe. We're kind of wrapping up here on questions. We will, just for everybody here, whoever sent in a question, that your advisor will know those questions and can follow up with you and have future conversations. Like I said, some are just a little too specific to kind of hop into right now.
Yeah, I'll just put some concluding thoughts. I just popped through and looked through, a bunch of the questions, and I'd say, I personally wish America was less polarizing at the moment, but we've gone through a bunch of periods like this prior. We went through 1920s, 1930s, 1940s, which were polarizing times. We've gone through tons of polarizing times prior, where there has been innovation. We have governments who spent a ton, and it was a mistake. Going back to the 1970s, we've had governments which haven't. There's no secret formula, and what we have done as a country, even with our mistakes, have just learned from them. And when I say mistakes, fully, totally across the spectrum, the Federal Reserve, government policy, the way the executive and legislative branch work across the board. So I continue to remain, and we continue to remain long-term optimistic on both the American story, on the story around innovation and general continuation of wealth. Does that mean it's going to be a straight line up? I wish, but maybe I wouldn't have a job if that was the effect, the result. But recessions and some of this it's just part of the journey. And so again, we really believe diversification and long-term investing is the name of the game. And so with that, thank you very much for listening. And as Mark mentioned, if you have any questions, reach out to your advisors. I'm around if necessary. I will make sure to react to all advisors. We're here for you. And Mark, I'll just kind of turn it over to you if you have any concluding remarks.
No, I think that was great. Look, we wanted to just reach out to everybody and give, just our general overview and viewpoint of what's happening in such an uncertain time. It's really hard to predict a lot of things because it's changing so rapidly. We will continue to follow up and continue to stay in touch. And, and yeah, that's, I mean, like I said, I agree with you, Joe, in terms of, I wouldn't look at it as a panicking situation. I've got a few texts here, a few questions here asking if it's a good time to buy because stocks are down. I'll just say that depends. It depends on each individual situation. And, that's also a really good conversation to pair with the tax harvesting and take back to and set up a meeting and really talk it through. As I know everybody here is trying to reach out to everybody and have as many conversations as possible. So I'll kind of leave it with that too. And, hopefully we do get to some real stability really quickly. Otherwise, maybe we'll do this again shortly. All right, we'll say goodbye on that. And I'm looking forward to catching up with everybody shortly. Bye.
Thank you.